Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and today I want to talk to you about the trends and the data that we track in our buyers agency to help our clients and ourselves achieve capital growth so that we can continue to leverage into more and more deals. And if you're not aware what the difference is between macro and micro data, I'm going to break that down for you. And you can actually take this data yourself and start tracking it yourself without the need for a buyer's agent, so you can go out there and actually do this yourself. And the reason that I'm sharing this with you is we get a lot of clients that want to invest in HMOs and unfortunately don't have the cash or equity available to do so because they need 350k or more. So we get a lot of people that have got the $80,000 to $250,000 sort of bracket that reach out to us, a lot of them. And this is the sort of data that we track for them so that we can double or triple their investment within 12 to 36 months. And then we can transition them from a standard investment property that's just focused on growth into a HMO that gets capital growth, cash flow, and debt reduction in the same deal, which is really the holy grail of investing, right? If you can tick all three of them boxes, there's no better investment. But sometimes you need to negatively gear and ride the capital growth wave so that you can build a bit of wealth and then start transferring it into a much better performing asset. So you've got macro data and micro data. Macro data is nationwide data that we track to understand, first of all, the state or territory that's going to experience capital growth, and then also break it down into suburb, local government catchment areas, and then suburbs as well. So we want to be looking for states, territories, local government areas, or suburbs where population is rising faster than the state average. You can get the state average from the ABS website. You want to track where new residents are actually choosing to live, not just the city as a whole. And you want to watch for areas that are attracting younger working families or skilled migrants. The second macro data point that we track is migration trends. So we want to look at regions people are moving into from interstate or overstate. That will also obviously change population growth. And so if you're seeing a lot of people moving from Victoria, Sydney, etc., to Perth like they have been over the last 2 or 3 years, which is what's really created a lot of this growth that we've seen. That migration trend also increases population growth, right? So they go hand in hand. So you want to check if your area that you are looking at is gaining net migration or losing it, and you want to focus on suburbs benefiting from lifestyle or affordability shifts. The third data trend, or the third macro data, is wage growth. So you want to be looking at local government areas with rising median incomes. So you want to make sure that people's wages are increasing, because if they've got more money, then they've got more disposable income. If they've got more disposable income, that means they can afford to buy a bigger house, spend more money, and owner-occupiers really drive price growth because they get the fear of missing out, want to keep up with the Joneses, or want to upgrade the houses. That will push prices up, and that means that we can take advantage of it if we see this metric changing ahead of time. You want to avoid areas where wages have been flat for years. You really want to see that kind of uptick starting to happen. Number 4 is job creation. So we want to be looking at new job hubs, industrial precincts, hospitals, major employers, shopping centres. Check how many jobs are going to be added to that area in the next 3 to 5 years, because that means people will need to move to the area, and that means there's a population growth, and that means that prices should increase because people will always need somewhere to live, and they would prefer to live closer to work because it's convenient for them. So you want to look for areas where jobs match the demographics of people likely to buy or rent. I should have numbered these, shouldn't I? 1, 2, 3, 4. Number 5, rental vacancy trends. You want to look for vacancy rates that are falling or staying under 1%. Now, if you've been listening to my podcast for a while, you'll hear me hanging REWA out to dry because they keep saying that the Perth vacancy rate is at 2.5%. And whilst it might be, I also believe that vacancy rate can be a bit of a false positive. And what I mean by that is The number of houses available for sale or rent has stayed the same for the last 2 years, but the vacancy rate has more than doubled. So how has that happened? The only way that that can happen is if there's less rentals in the market. So it's a bit of a false positive, the vacancy rate, but it's still one that you want to track, because if you see it decreasing, then you can look into that suburb. You can check if wages are increasing. You can check if population's increasing. You can check if there's migration trends into that suburb, and dig a little bit deeper on why that vacancy rate is falling. Rising vacancy rates can also indicate future oversupply, so we obviously want to stay out of them locations if we can. Number 6 is affordability pressure. So we want to compare the median income to the median rent. When it becomes too unaffordable for people to live in certain areas, then that means prices start to stagnate. We can look at places now like Rockingham, Mandurah, Armadale, Gosnells in Western Australia. They've seen some incredible growth, but it's getting to the point now where it's getting very, very unaffordable to live in these suburbs. And the people that live in these suburbs have a very low medium income. There's a lot of people that don't have incomes in these suburbs as well. So it's only a matter of time before them suburbs cap out and can't rise anymore. And this is why I've been saying for probably the last 12 month, I reckon. Yeah, at the start of this year, I said the market's going to be broken into 3 segments, and I said the middle segment of the $750,000 to $1.5 to $2 million mark, that's going to be the market that moves the biggest, and it has done. You obviously, because of this affordability pressure, you want to avoid markets already at affordability ceilings. Okay, this is the big one. The next one is housing supply versus demand. Supply versus demand. This is like the first and foremost, right? When people always say Perth's overcooked, I'm like, yes, it's gone up in value a lot, but let's look at the very basic fundamentals of supply and demand. Supply is how many houses are on the market and how many houses are coming through the supply chain to the market to meet the demand. The demand is population increase. The demand is migration from interstate and overseas. And right now, Australia in general is migration tap is on, but different states and territories are attracting more migration than others. Perth is getting smashed. We need to be building 30 to 35,000 houses a year. We're currently building around 20,000. We've got a 10 to 15,000 home shortage every single year in this state, and the migration tap is still on. I've been saying for the last 12 months, this will get worse before it gets better. It continues to get worse. It will get worse. And well, I don't know why I'm laughing, because it's not funny. It's not funny for the people that need housing, but the people that have already invested, the smart people that track these trends, that seen this data and took action and invested, are the ones that are making benefit of this. And this is why investors get rewarded financially and it becomes lucrative for them, right? Because they are taking risk based on data and research and hard facts. And when they get it right, they make money, and truly so, because firstly, you've saved up hard to get the money to invest, and then you've took the punt to actually invest, and you've done well. So if you've made money from real estate, well done. After housing supply versus demand, we're looking at building approvals. Again, this will track into the supply side of things. We want to look for falling approvals, signaling future tight supply. Now, Perth is seeing more building approvals getting approved, but we're not finishing these houses fast enough, and we're not we're not building enough properties to keep up with demand and the migration into the state. So you want to watch for big jumps in approvals, which often slow growth later. And you want to check the type of approval, so houses, units, townhouses, or apartments. Not many apartments are getting built here in Perth right now. Not many infill developments of townhouses, that sort of stuff, are getting built in Perth right now, because feasibility still look very tight and not many people are taking the punt. But lots of houses are being built on the fringes, because it's very easy for people to buy a block of land, build a house. You don't need to get a return on investment for a feasibility if you're building 3 to 4 townhouses on an infill block. Next one is interest rate direction. You want to look at rate cycle indicators that shape buyer sentiment. Now, markets are driven by 2 powerful emotions: fear and greed. When interest rates are going up, like they have done, normally fear kicks in and everybody sits on the fence. And when people are sitting on the fence, that generally slows the markets down. And when interest rates are going down, and when I say down, they're going from 6% to 5% to 4% to 3%. This is when people get greedy, because money is cheap and people can borrow more money. So they start to borrow more, they start to invest more. And that drives prices up. Higher interest rates also restrict borrowing and slow weaker markets. And weaker markets, or higher interest rates, restrict borrowing and slow weaker markets, because in the weaker markets, people have lower incomes, which means they can't borrow more money, which means that they get tapped out and they can't upgrade their houses. So, like I say, the Manduras, the Armadales, Gosnells, the Rockinghams, they're probably at their max capacity right now. And they're suburbs that we would be avoiding at this stage in the market. But there is still lots of suburbs that are still primed to move in the right direction over the next 12 to 24 months in my eyes, tracking this data. Now, this is just some of the data that we track. We track over 50 different data points. I'm just sharing some of the high-level ones that you can use right now to go out there and start tracking them yourselves, so you can make sure that if you're not using a buyer's agent, that you're at least tracking the right data. Infrastructure spending, this can be a good one again. If there's hospitals being built, if there's new roads being built, if there's shopping centres, if there's hospitals, did I say hospitals already or shopping centres already? Any sort of big major infrastructure, airport expansions, all that type of stuff. These can attract people to live in them areas, transport upgrades, commercial developments. So if these sort of things improve lifestyle and improve access to certain suburbs, then these generally increase in price. It's one of the many metrics that you need to throw in there. So if you're seeing all these other things and there's infrastructure spending going on there, then it's probably a good place to start looking at the micro data that I'm going to share with you in a second. And then you can start looking, lastly, at the macro trends of planning changes. So you can look for zoning changes that will either limit or expand supply. You can track state-level planning shifts that are affecting density or greenfield areas. And you can also check for areas with tighter zoning that can show stronger long-term capital growth. Now, I've seen people invest in areas because they thought zoning was going to change, and it hasn't changed because councils didn't do it in the times that they did. So that is probably one that I wouldn't be buying specifically for a zoning change. I'd rather be tracking the other metrics and investing for the other metrics rather than the zoning thing. So they are, I should have numbered these guys, sorry, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 different trends or bits of data that you can track on a macro level across the country, local government area, and then into specific suburbs. Now, when you start looking into specific suburbs, the micro data that we track, or some of it, days on market, first and foremost. When I first got into real estate in 2014, 2015, days on market in Perth were very low. And then literally 6 months later, days on market were very high because we had an oversupply of properties. If we look at now, we've got 2,000 properties available on the market. Back then, we had an oversupply of 14 to 16,000 properties on the market. Yeah, people weren't buying. People were leaving the state because the Gorgon project finished, the Wheatstone project finished. A lot of big infrastructure projects had finished and people were then leaving the state, so population growth was going down. And this is what affected the last Perth downturn. Right now, this market is the complete opposite end of how that happened. So days on markets within a certain suburb, falling days signal increasing demand, and you can compare the current days on market to the suburb's 12-month average. And you also want to watch for properties selling before the first home open, because then that is then telling you that it's changing from a buyer's market to a seller's market. Seller's markets mean that the sellers have more control, they can start demanding more price. A buyer's market means there's an oversupply of properties on the market and the buyers are in more control because the sellers want to sell, the buyers have got the money, and then they can start negotiating more terms and discounts and stuff like that. Which leads me nicely into micro data number 2, which is discounting trends. So look at whether sellers are accepting smaller discounts, as in like if the property's on the market for 100 grand, did they sell it for 99,000 or did they sell it for 90,000? If it's a 10% discount, then that is a big drop for somebody to take. If it's selling over what it was on the market for, then that's a very good indicator that you're in a hot market. Rising discounts indicate a softening demand. Number 3 is owner-occupier ratio. Now, you want to look for pockets with high You want to look for You want to look for pockets with high owner-occupier appeal. What does that mean? You want to look for areas that people want to live in, because that then attracts more investors. But if there's more owner-occupiers that live there, they will pay more for a property than an investor, and that will push a price up, right? More owners equals more pride, equals better streets, equals higher price points for property. Higher investor concentration can drag growth down. Hello, Mandra. That place has just been smashed with investors because all the buyers agents from Oman East were going, oh my God, it's so cheap. It's next to the water. It's absolutely incredible. Mandurah will be the first suburb to drop in my eyes. If you're buying a Mandurah now, please, please, please invest with caution because it's already done what it needs to do. Number 4 that we track in terms of micro data, God, I keep getting my data and my data's mixed up, is school zones, right? Check which schools drive demand, especially primary schools. You want to check price differences inside and outside of them zones. And when you start tracking this, you'll see some very, very interesting trends that start to form. You want to look also for enrollment growth, which pushes demand for nearby housing. Now, there are specific schools in Perth where people are buying in them suburbs just to get their kids into them schools. That causes FOMO, that causes price increases, and these are the things that we want, right? So if you can get into an area where population is increasing, people are moving from the state, jobs are increasing, and you can get into a really good school zone, hello, capital growth. Now, if you can do this, if you can track all of these bits and you can get HMOs in these areas, which is essentially what we've been doing since 2017. We've been investing in these areas for our clients, buying established properties and converting them into HMOs, and they've seen some incredible capital growth. Prices doubling, return on investments are like 5 and 6x. It's just absolutely phenomenal. After school zones, we want to be checking amenities. So we want to be looking for access to shops, cafes, parks, and medical centres. These things obviously attract owner-occupiers because they want to live in areas that are really, really good. You want to look at walkable pockets that attract stronger long-term demand, and new amenities being built often boost future values. Now, there is a thing called Walk Score. You can type your suburb, you can actually type the address into the Walk Score website, and it gives you a Walk Score. And what that Walk Score means is how walkable is this house that you want to invest in, and to shops, parks, medical centres, cafes, restaurants, all the things that people want to live near, right? Walkscore.com.au, I think it is. All right, check it out. After amenities and the infrastructure upgrades that we're looking for, we want to be checking crime data. So we want to compare crime level street by street. There's plenty of websites out there that you can track this on really, really easy. You want lower crime areas that attract better tenants and stronger buyers. Again, and I don't mean to just keep bagging these suburbs, but your Armadales and your Gosnells, they are low socio areas. Their crime rates are a lot higher, and that's why these areas kind of go up and come back down in value pretty fast. Everybody gets in, gets the capital growth, everybody gets back out. I'm not saying that these areas are going to drop like they did, but I'm saying that they are not going to see the growth that they have seen over the last 2 years. Transport links, again, we want to look at proximity to train station, bus routes and major roads. This will come back to your walk score. Shorter commute times increased by demands. It doesn't necessarily mean that you need to be close to the CBD because not everybody works in the CBD, right? But you want to check that future transport upgrades can lift values early. So the first house that myself and Joe bought, which was in Hammond Park, which was our first HMO, we converted that into a HMO, like I just said, but we bought that property because we knew there was a train station that was going to be built, which was the Auburn Grove train station. That property is now worth over $1 million. It cost us $550,000. You want to be checking nearby development, so look at how many new dwellings are coming to that pocket. So again, we don't want to be on the fringes. We want to be avoiding Two Rocks, Alkimos, Bullsbrook, Ellenbrook, Byford, Mandurah, South Yunderup, all them areas just on the fringes, right? Because there's pockets of land next to them that can be chopped up and subdivided. All of a sudden, a new developer's just released 400, 500, 600 blocks, and that really stagnates the growth potential of your property. So too much supply can cap growth, even in a strong suburb. So you want to check if developments target the same buyer or renter demographic as what you're investing in. Now, if you're buying in these fringe suburbs, generally you're going to be buying a 3x2 or a 4x2 because that's all everybody ever seems to build in them. So if the developers are going to build and just flood the area with 3x2s and 4x2s, then you probably don't want to be investing in that area in that style of housing. All right, we're getting to the end now, guys. We've got 3 more to go. Street by street sales. You want to look for streets with stronger recent sales results. Now, a way to get this is to speak direct to real estate agents, because they'll start to tell you about areas within that suburb called like the Golden Triangle or the Purple Pocket or the whatever they call them, right? All these different names for these areas, right? They'll say if you live on this street and this street and this street, these are really good streets that people want to live on because of X, Y, and Z. Myself and Joe bought a property in Kensington not too long ago, and we were told that was called, in an area called the Golden Triangle. 2 years later, we sold it. Well, it was less than 2 years. It was like 18 months after we settled on it. We sold it. We made $400,000, capital gains tax free, because it was our principal place of residence. In, out, thank you very much. You also want to avoid streets with noise, traffic, or poor presentation. Google Maps is pretty good because you can jump on there, pop up and down. You can see if somebody's got like 3 or 4 cars on the front that have got no wheels on them. They're propped up on jacks and stuff like that, and the front gardens look a mess. If you're in them streets, try and avoid them, because this does affect capital growth within that street. You could be one street out. The street looks so much better, so much more presentable, and it performs much better than the other one. And you also want to compare land sizes and block shapes within that pocket as well to see if certain land sizes sell for more than other land sizes. Next, you want to check for rent inquiry volume. So you want to check how many inquiries similar properties receive weekly. So if you're going to buy a 3x2 in Kensington like we did, we want to check how many 3x2s are there available for rent, even though we lived in ours. I'm just giving you this as a comparison. So you want to check how many 3x2s are in that suburb for rent and what they've rented out for, how long they're on the market for. Give the agents a call, give them a call. Real estate agents love to chat about what they've done, and they love to tell you about what they've done and how much they've rented it for. Rising inquiry signals raising demand. So if a real estate agent says we could rent a 3x2 in this suburb tomorrow for this much money, that's a good one. But if they say, oh, we don't get much inquiry on 3x2s in this suburb, then that could be an issue, right? That means, why would I want to buy that if there's no demand in the suburb for it? And lastly, rent increases. So we want to check rental growth in that suburb over the last 6 to 12 months. We obviously want to be seeing increases. If it's doubled, if it's just spiked from like 300 to 600 overnight, then you want to be looking into why that has happened. But it means that rising rents can also lead to rising prices, because if investors see rental yields increasing, then they're going to invest in these areas along with all the other metrics that they track as well. So quickly, just to finish this off, because I've got to go to the dentist. Macro data, we're tracking population growth, migration trends, wage growth, job creation, rental vacancy trends, affordability pressure, housing supply versus demand, building approvals, interest rate directions, infrastructure spending, and planning changes. And then for your micro data or data, we're tracking days on market, discounting trends, owner-occupier ratio, school zones, amenities, crime data, transport links, nearby developments, street-by-street sales, rent inquiry volume, and rental increases. So there you go, guys. They are some of the some of the data that we track when we are doing the research on suburbs to help our investors double or triple their money within 12 to 36 months, so that they can then transition out of a high growth, low yield property into a HMO, which gives them high growth, high yield, and debt reduction in the same deal, which we call the Holy Grail, because you get all three of them things in the same deal. Okay, guys, thank you very much for joining us again on the HMO Property Show. And remember, every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.